because I'm going to have lots of questions at the end. This is one of the, as Jeanette said, I mean, I want to deliver what is most current and most important to the audience, and you're going to discover why as we go through the presentation today about what the importance of Monday was, and the critical days that we look at in the market in terms of determining the market's direction. And by the end of today's presentation, I'm going to share with you a strategy that predicts the S&P 500 direction to 80% plus accuracy, back-tested over 2 years. So that's the cool little giveaway we're going to get to at the end of the presentation. So do stick around, and that's why I was waiting for Monday, and you'll find out later why. But as a result of what's going on, the topic that I really wanted to share with you tonight is my favorite strategy of trading today's market, and it's a combination of capturing the crash as well as how to scan for the most potentially profitable setups. And of course, as we get toward the end of the session today, we can have an open forum of asking about current positions we're in. I don't mind sharing with you what stocks that we're buying at the moment or holding at the moment, and talk about what's up for next week. Of course, it's not a recommendation to buy and sell. It's just a general discussion for educational purposes. But let's talk about the main reasons why people are failing in the market now. And I've done this myself, even in recent times. We're all subject to this. Most people miss out on opportunities in the stock market because we fail to take action. Now, I'll put my hand up straight away and say that I've lost opportunities for that reason mostly. Anyone else share that same problem? You see a good opportunity and you think, oh, I'll give it one more day, then the next day it's already up 10% or things like that. The main reason that the most people fail to take action is because we lack confidence, because we don't have rules, or we don't have confidence in the rules. I mean, today it's a wonderful world where you have people like Jeanette who organizes such wonderful events with Hubert and myself and a lot of the other speakers you've had on today. But how do you know who to listen to? And when you have so many different directions coming at you, how do you start to consolidate down to an A through Z checklist that lets you make a decision with confidence? And most people don't. So the real question you've got to ask yourself in able to get over that psychological block is, do you believe the rules you're being taught, for first? Do you believe the market is predictable? And do you believe that you can do it? And if you can believe those three things, then you can get past that psychological barrier. And hopefully through the presentation, we're going to be able to knock these three things out of the park. So firstly, let's remember back to Christmas. You remember back last year where, we had that little dip in the market back in October, and it rallied back up and everyone said, it's just a correction. Don't worry about that, because are you ready for the Christmas rally? Right. Well, that was a great opportunity where the smart money was just feeding you information, telling you, hey, great time to buy stocks. And, of course, we saw the absolute opposite happen. And the main thing you have to realize, of course, about the stock market is that it's the biggest business in the world, right? It's capitalism at its best. But capitalism is not a charity. It's there to take your money, right? The smart money, the 1% of the world owns 99% of the wealth because they're very good at taking it from you. And the way they do that is through noise. It's through Goldman Sachs publishing the S&P 500 is going to go to 2,000 the day before it drops to 1,800. The smart money's objective is that they want to sell at the top and buy at the bottom. And for them to do that, that means that everybody else has to be convinced to do the opposite, right? There has to be 99% of people doing the wrong thing to the other 1% to make money off you. So how do they do it? Through noise. So how do we start to read through that noise? How do we start to predict where big money movements are going to happen when we can't trust what we hear? In fact, I was watching a documentary, if you want to look it up on YouTube, it's called The Truth About Experts. And they did a study of financial analysts. And they said that they basically did a study of like hundreds and hundreds and hundreds of economic reports that have been published on, BNN, CNN, Mad Money, all these different types of, expert shows. And they said that close to 100% of all of the predictions were wrong. And 85% of investors, statistically, lose money. So how do you, as an investor, go out and find a good idea or a good investment or a good trade when statistically 85% of what you're being told is going to lose you money? So how do we do that? Well, we have to look through the CRAP, excuse my French. We've got to look through the rubbish. We've got to look at what the real story is. Now, let's talk a little bit about the noise for a second. Back on July 29th, we published a video, which you're all welcome to see if you want to go to our YouTube page. On July last year, we published an article, a video, saying that we felt the market was going to crash. Of course, it did. Now, these are the main reasons, and they're still applicable. What we've got in front of us at the moment is we've got Asian economies that have huge weakness. Greece, Europe, everything is falling apart. The ongoing result of that, and this is backfill, so if you don't understand it, don't worry about it, but this is just to set the precedent of what's going on here. The result of big problems in the background is that you get bankruptcies, and this hasn't fallen yet, but this would be the next big catalyst, is you get highly leveraged companies, credit tightening, all that kind of thing that starts to contract. That results in liquidation in the stock market. So if you actually, the Bank of America, Merrill Lynch, published a report last week that said that we've just finished the longest streak of equity redemptions in terms of people selling off the mutual funds and things like that, the longest 5-week streak with the highest level of selling that we've ever seen since 2008. So liquidation is happening. And the places where that's occurring most is in these high P/E ratio companies. If you look at all the big and Amazon and Priceline, a lot of these big high flyers have all been whacked. LinkedIn, of course, got a huge knock in the face. Selling is going on because companies are going into survival mode and investors are going into survival mode. If you look at the ratio of how many insiders, the people that own the Fortune 500 companies, what they're doing, there's about a ratio of 13 people selling to every one buying over the last 6 months. That's a scary fact. So what do we do with that? What do we do with that information? Well, we have to think, we've all heard this statement before, right? Insanity being the definition of doing the same thing again and again without expecting a different result. What are we doing differently to 2008? Because 2008 to some people was one of the worst years they remember for their financial career. But it was one of the times where you could have probably made a huge chunk of money had you been on the right side of it. So what are we doing differently? Are we recognizing the ways that we can predict this and how we can then profit from it? Because trading at the end of the day is all about making money. Give to charity in your spare time. So when you're in the stock market, if the market's going down, you bet against it. That's how you make money. So how can we learn from 2008? All right, well, let's get into that. So what I want to point out to you firstly is how 2008 occurred and how it's very applicable to what's going on right now. So just a quick kind of scan of the audience. How do most people feel about the market right now? And there is no right answer. I mean, the market is all about speculation. But who here thinks bullish? Who thinks bearish? And who has no idea? What's the... all right, lots of bearish, a couple bullish. Setting up for another leg down. Greed is good in the market. Gotcha. Interesting. Now, it's funny that about 90% of people say bearish. So really what I should be doing right now is buying all the stocks I can. Yeah, you call that you call the taxi cab index. Find out what the taxi cab driver is doing on the street and do the opposite. Yeah, but no, there is a very good reason why it should be bearish, and let's talk about that now. All right, so you should have my chart popping up in front of you. And what we're going to do is we're going to go to a weekly chart on the S&P 500. All right, now how do we detect big money? How do we detect where smart money is going? And firstly, before I answer that question and before we go into the chart, the reason why this is so important is because, as many of you probably know, 80 to 85%, as they estimate, of all of the volume in the stock market comes from computers making decisions to buy and sell. As I mentioned earlier in the presentation, I'm living in Playa del Carmen right now. I roam around the world, living out of a suitcase. But one of the guys I met here when I arrived in January was a bloke who owns a high-frequency trading firm. He works out of Atlanta, but his firm is spread across the U.S. And his firm alone accounts for 10% of the volume in the U.S. stock market and 5% of Canada's. That's mind-blowing. That's a huge. So 1 out of 10 shares that you see trade every day comes from his computers. So when you start to think about that, you start to understand where the volume comes from. And so how do computers make decisions? They make decisions with patterns. So in order to understand where the market's going to go, we need to understand how these patterns work. And that's why this is one of the most crucial things in your trading career that you must know. So let's go back and look at how these patterns apply to current day markets. All right, so I'm going to go back firstly and talk about 2008. All right, so 2008. Well, let's start with 2004. From 2004 until 2007, the S&P 500 was in a very easily recognizable and very easy to trade pattern, and that is a upward channel. Now, one of the big mistakes that traders make is they often draw trend lines from right to left. So they'll go and they'll do something like that. And they'll say, oh yeah, that's the pattern. Does anyone suffer from that problem, not knowing where a trend line starts and ends? One of the most valuable things you can ever do is make sure you always go left to right, always. So people say, what's the value of looking a year ago? Well, you have to go back a year to know where the trend started, to know when the next trend begins. So when one trend ends, that's when you know to start looking for something new. Now, this uptrend ended in October 2006. It then tested that channel from the top, and then that is when the actual crash began. The actual crash did not begin in 2008. It began in March of 2007. And the reason why is because that is when the high-frequency trading, the 80% of volume in the market, began creating a what? What did we end up, what was the smart money creating at the top of the market? A head and shoulders, exactly. Now, there are close to 100 different technical analysis patterns that exist in the stock market. We just had the Super Bowl. So think about it this way. A great coach to a great football team has a playbook. And the playbook is there is designed to confuse the enemy, to have a way of moving the pieces around that's not chaotic. It looks chaotic to anyone who's never seen a football game, but it's very well organized movements to achieve a goal. Now, the stock market is no different. The playbook here is the Head and Shoulders. And from out of those 100 different patterns out there in technical analysis, the Head and Shoulders ranks number one, the best reversal strategy in a bull market. And the reason for that is because it's designed to lure investors in to buying at the very worst time. Because how does it work? It makes a low, then it makes a higher high, making everyone buy into the stock right at the very top before it breaks down. So that was our Head and Shoulders. Now, if we measure that Head and Shoulders, you'll see that we get, and we always measure from the bottom of the top candle to the neckline, and you'll see we get the drop when we broke down was exactly where we broke down to. We then got another Head and Shoulders. And if we measure that, you'll see that we actually get the same move. You can see I've already got it measured there, right down to there, just under 1050. That becomes support. That was where we rallied back up into. And then we actually created an inverted Head and Shoulders on the bottom. And that is where we rallied back up. Okay, so the point of my story here and why we're looking at old data is that the seemingly chaotic drop of the market wasn't chaotic at all. It was, in fact, a very well organized, or maybe I should say a very well orchestrated drop where the levels it dropped to and reversed were highly predictable by one of the most profitable and probable patterns out there. But we're all too busy looking at the news to believe that it's that accurate. But that's what controls the market. So let's fast forward to current days. 2012 through 2015, same upward channel. We broke down from that channel in August 21st, on August 21st, I should say. We've created a left shoulder, we've created a head, and we're right up on the cusp of that right shoulder now. So that is another, I'll just get some of my other stuff out of here. I'll leave everything. That is another reason why we should be very concerned. We have the same exact pattern occurring. Now, what would that predict? That would predict a drop, if we measure the Head and Shoulders, to a breakdown to 1600. Now, 1600 has some very interesting relevance because 1600 is actually the Fibonacci extension from the top of the rally to that reversal right there. Okay, so remember that. 1600 is the 100% Fibonacci extension. Let's take that away. Let's use some other technical analysis to confirm our theory. Let's go for a Fibonacci retracement from leg one of the rally, the short term. So it's from 2011 low right up to the high there in 2015. Where is the 50% Fibonacci retracement? 1600, exactly. Okay, well maybe that's just lucky. Let's go and have a look at the Fibonacci retracement right from the very beginning of this entire reversal. Where's the 38.2 Fibonacci? Right there, just under 1600. So what we have is we have following a breakdown out of a 4 or 5 year uptrend, and we have the Fibonacci's confirming the target of that head and shoulders, and then we go back and we look at one more key thing. Hang on, has my mouse run out of batteries? Here we go. 1 second, folks. What's the problem with Mexican batteries? You never know when they're going to stop working, I suppose. Okay, all right, back to the touchpad. All right, okay, so the other thing we want to look at then is we want to look at evidence of smart money. Now, once again, we'll go back to the 2008 example. Now, question for the audience. How do you define smart money? Better still, what would you consider the definition of a real uptrend is? What is a real uptrend? So when you want to know, hey, is the smart money buying with me, or are they selling to me as this stock goes up? Higher highs, higher lows, okay. All right, well, let me challenge that idea. I'm going to go out on a limb and say higher highs and higher lows is wrong. And here's why. Because would you buy a stock if it looked like this? Would you want to search or scan for an uptrend that looked like that? Probably not. No, exactly. Because you've got higher highs and higher lows, but it's contracting in the range. What if it wasn't? What if it wasn't? What if it was an equal range? But let's say the stock was closing lower and lower and lower in the range, even though it was making higher highs and higher lows. You wouldn't buy that, would you? Or better still, hang on, what if it was doing that, and as it did that, the volume was dropping? Would you buy that? I sure as hell wouldn't. In fact, that's the kind of stock, if you combine that with a contracting range, I go and take my trading account and sell everything I've got and buy a ton of puts on it, right? I'm using an extreme example, of course, but that is the perfect example of a short. Okay, so really an uptrend isn't just higher highs and higher lows. It's a little bit more than that. And that's why traders go and complicate their screens with hundreds and hundreds of indicators. Does anyone here have a screen that looks like this? Anyone have a screen on their trading platform that looks a little bit like this? Because all of these indicators are simply there to tell you one thing. What does the stochastic tell you? It tells you whether the stock closes in the top of the range or the bottom of the range. On balance volume, what does it tell you? Is volume going with the stock's move or against the stock's move? Directional movement, what does it tell you? Higher highs and higher lows or lower lows and lower highs? All of this stuff is analyzing something very, very simple, price action. All we really want to know is the actual way the stock is going real or is it not? So this is all I trade with. I trade with moving averages, the chart, and money flow. And I've been doing it for 13 years and I've tripled my account in the last 8 months. So, and if anyone wants to go in, and I'm more than happy to share my trading statements with anyone who's interested. We've tripled our accounts in the last 8 months because we simply follow what is the pattern, where is the most important support and resistance, and where is the smart money going. And that is the most important 3 things. So what did I trade in the downturn in January 2016? I would love to tell you, and I will in a moment. Let me tell you how I traded it first, then I'll show you what I traded. Smart money essentially is looking at whether the stock is closing in the top half of the range or the bottom half of the range, is volume moving with the stock, and is it making new highs and new lows? Now, Twig's money flow is an excellent indicator that actually combines all of those things and tells us that very fact. Is the money going with the move, or is the smart money selling to you? Okay, so when we see this giant rally in 2004 to 2007, what do you notice about the smart money as the market rallied away? And do you notice that that trend began the very day that that up channel stopped working? The smart money started going in the opposite direction. So people say the crash of 2008, but that's not true. The crash began in October 2006 when this whole structure started to begin. That's when the smart money started to sell their positions to you. Again, let's fast forward to current day. Now we've had this long, big channel, right? The channel going up and up and up and up. I'll just take the Fibonacci's out of here to decomplicate the situation. Okay, so we've got, again, this one channel big up, and then what you see is what? Does anyone see a very similar scenario? Anyone see the striking similarities of how the market is setting up? As we form, yet again, a head and shoulders after a 4-year channel, the smart money has been selling off since the beginning of 2014. And we can tune into all the great pundits on TV that are going to ring all the bells and buy time. The bulls are in the market. You know who I'm talking about. Great. But behind all of that those sound effects and all of those news articles and those pundits on TV, what is the smart money doing? They are selling. And again, Bank of America Merrill Lynch report, as I said last week, highest streak of exodus from the stock market since 2008. Now, there's one other thing that I'd like to share with you which is interesting to watch, and that is the corporate high-yield bonds. Now, I don't know about you, but I don't trade bonds. That's a big boys game, and I'm just a little trader that likes to have some fun and make some money on the way, right? But what do the big boys trade? When I say big boys and girls, I mean the Federal Reserves, the central banks of the world, the Fortune 500 company owners trading in billions, not millions. And one of the signals of confidence in the U.S. corporate America is the levels of corporate high-yield bonds. So if you ever want to know where the really smart money is going, take a look at this. Take a look at HYG. And what you'll notice is that as of 2008, 2009, the bonds agreed with the market movement. The S&P plummeted, high-yield bonds plummeted. The market recovered, and so did the bonds. And everything seemed to be just fine. Everything was moving in synchronicity until 2013. Now, did anyone know what the specific events were going on around 2013? What was happening in 2013, 2012 that might have said to the smart money, hang on a second, what's all this about? Any guesses? Yeah, Greece, election, quantitative easing, all of those events. And so when you actually plot a divergence of the high-yield bonds versus the S&P 500, take a little look at what happened. So when I start to talk about the downside potential of this market, look at how far off the real money thinks we are from the actual value of the S&P 500 today. The green line, by the way, is the S&P 500. We are a ways off. Now, you look at the overseas markets, you look at Australia, you look at Canada, you look at the Nikkei, look at China, you'll see that they would pretty much match what the HYG looks like. The only one that hasn't is the economy where we pump the most money into, and that is, and that's log scale, if you're interested in that one. Is the U.S. economy. So these are the warning signs. Now, so the idea of how we take, so I mean, I guess the thing we want to drive to is, so how do we start to apply this? Well, I told you I would tell you what we've been trading and how we trade it. So before I do that, I'm going to share one last little nugget with you. And perhaps this is probably the most valuable nugget I can share with any type of trader. And that is a strategy that predicts where the S&P 500 will go for 1 to 3 weeks, back-tested over the last 2 years, over 80% accurate. Would anyone like to know that? Would anyone find that valuable? Yes, I know it's a stupid question. All right, show me the money. Yeah, you got to put an exclamation mark after that, Pawsey. All right, so we've talked about smart money. Okay, so how does smart money communicate? They don't just kind of randomly run around the market and come up with these ideas on their own. It's a very well-organized community. Now, there is a language that is spoken in technical analysis that dictates where markets will go next. And this language is called open range. Now, we charge $500 to teach this course, and it's not something we give away easily, but as the previous speaker said, Jeanette's got a way of twisting people's arms, and we want to make sure you come away with some value here. So this is one of the best kept secrets amongst traders, and probably one of the easiest things I can teach you that will give you the most immediate value, and that is open range. So how does open range work? Well, basically open range is the strategy of observing the first trading day of the month and options expiration day. So we've talked about how we predict the market's macros. We've talked about how we identify where the market should go, and we're looking at a 1600 target on the S&P 500. So how do we then time it to get the best out of what to trade tomorrow and for the next few days? Because obviously that's the problem. I think we'd all agree we've been waiting for a crash to come since about 2013. But if you started shorting then, you probably would have burnt your account out. So how do we time it? Well, open range is the way that we can start bringing this all together. So again, what we look at is the very first trading day of the month. Let me just move this out of the way. So, okay. Okay, let's just get rid of these. Here we go. All right. So the first trading day of February was there. Okay. So the range of that candle was that high and that low. That, therefore, for February, is open range for February. Now, what we look for then is we're looking for a 3-point break above or below that range. And depending on which direction it goes in, tells us where the market will go until the next open range day, which is options expiration. So, in this example, we had a 3 or more point close below the range of the first trading day of February, and that told us that until the next open range day, the market would close below this range. So what that means, how we trade that, is immediately, once we see the open range turn negative, we're going to be slamming on the shorts. Right? Buying puts, shorting stocks, until we get to some kind of reversal point, which of course we did, this double bottom, and then we start to take profits until it breaks through the next zone. This actually, by the way, is also the bottom of the head and shoulders pattern on the larger scale. Okay, so yes, the open range is the full day of the first day of the month. So that gives us the negative signal. We short the hell out of stocks until we get to major support. We take profits. But even then, even though it rallied back up, you can see that by the next open range day, being February 19th, we were still closing beneath that range. Now, we have as I said, we have a whole course on this that I'm happy to give you. And it'll show you how this works in detail. And we actually go back through the last 2 years. And if you actually go through and plot this and apply it, you'll see it's over 80% accurate in predicting where the market will go. Now that gives you a huge advantage, because that means that once you figure that out, that very next day you know whether you're scanning for high probability patterns to buy or high probability patterns to short. So, does that make sense to everybody? Now, if we fast forward, options expiration then resets the open range, and you can see there was the open range there, and what's happened? We broke higher. What's the market done? Gone higher. And then that finishes out on Monday. So we're actually coming up to an extremely exciting week, because we are right at the top of the right shoulder on the head and shoulders on the S&P 500, and that comes perfectly timed with open range resetting on March 1st. And when it does, that gives us 1, 2, 3 weeks of that bias being in effect, whereas in February, we've only had really 1 week and 1 day. But as of March 1st, we get 3 weeks of the bias being in place. And if we're lucky, it'll be to the downside. Okay, so questions. When I say options expiration, do you mean weekly options or monthly? We're looking at the monthly expiration. So options expiration and the first of the month. These are the days where the market makers set the important levels as to where they're going to push the market. And I can't tell you who taught me this. Well, I can't say. But this is a very well kept secret, and it's very, very, very accurate. Go back and have a look for yourself. Now, or if you want, as I said, we'll share the video with you so you can actually learn it. But so we're looking at 3-point close. Okay, so so then how do we go and take all this wonderful information now and put it into practice? Well, what we do is we start learning to accept that, you know, really, how do you want to make your investment decisions? I mean, look, I know that I'm kind of, throwing out these hypotheticals that I know the answer to already, but I'd just like to know how many people in the audience here are constantly stressed out about their portfolio. How many people, even if you're making money, how many people here are always feeling stressed out about their investments and trades? Right? Why? Why do you think you're stressed out? What's actually the root or cause of that stress? It's because it's the fear of the gamble. It's the fear of not really knowing what you're doing, or that you're really in control of things. That there could be losses coming around the next day that you aren't willing to take because you don't have a strategy in place. Where you want to be, where you want to get to, where we as educators have the responsibility to take you to, is the point where you don't worry anymore about whether you're right or wrong. I don't. When I trade, I do not worry whether I'm right or wrong. I sleep very well. Because when I make a trade, the only question I ever have to ask is not what, my buddy down the road thinks. It's not what my other coach at Acorn thinks. It's not what the news articles are saying. Wow, big expectations on earnings tomorrow to scare me out of a trade. That's all noise. And again, remember, 85% of it is wrong. So why listen to it? Don't listen to the you-know-what. All you need to worry about, and all I worry about when I make a trade, is does it meet my rules? And that comes back to what I said at the beginning. Do you have a set of rules that you've applied thousands and thousands and thousands of times the exact same way on the exact same pattern and have built confidence in it? That's what you need to have. And that's why with open range, I'm absolutely convinced we're going down to 1,600. If we break above 2,000, I'll change my opinion. My rules would dictate that I should. But despite the fact that I'm convinced we're in a big problematic market, open range told me last Friday to go long. So I went long. So I'm not worried about what I think. I'm worried about what my rules tell me. And do the rules tell me to buy? Do they tell me to sell? And that's what we want to do. That's what we want to get to. So how do we build these rules? How do we start to, obviously avoid the emotional decision-making? And some questions about open range here. I'll just address those quickly. Does open range work on specific stocks? It works on the market. Don't ever worry about specific stocks. It is not a stock market. It is a market of individual companies. And if you ever trade, don't ever get trapped into trading the stock market. Trade stocks. Because I'm a huge believer that a good trader should be able to make money only going short in a bull market. I believe that a good trader should be able to make money only going long in a crashing market. Why? Because there will always be stocks that go up and there will always be stocks that go down. And that's dictated by what patterns they're in. So, you know what? Let's talk about some of the trades we've done. Let me give you an example. So, this week, this was one of the ones we bought call options on. So we saw that the market, the open range was positive. And so using one of my momentum scans, this one was alerted to me on Wednesday, February 17th as a buy. This is one of my scans called a fallen angel. So every night I run the scan, and this is one of the ones that told me to buy. Now, I didn't buy it until we bought calls on Tuesday or Wednesday. And we bought the $12 or $12.50 March calls, and ahead of earnings, because what basically we saw is that the open range was positive, and we wanted to go the long direction. So we searched for the highest probability patterns, and this is a high probability pattern. And if you have a look at the smart money, what do you see? Stock plummeting, smart money shooting up. So by the time that we got in over here, look at the difference in price. When the stock was $19, the smart money was -6. But when the stock was $11, the smart money was -8. So almost the same value, but 70% difference in price. What's that tell you? It tells you that there's accumulation going on. It tells you that something's going on that the smart money knows that you don't. And that's how you trade, not by listening to the garbage on the news. Not that all of it's garbage, some of it's good. But this tells you much more about the true story. That's where you make money. This was a 300% return overnight for me on the options. Sorry, 257%. Here's the other one. Even though we felt that the market was going to go up, we still found great opportunities to go counter trend, to go down. And here you'll see the same type of strategy applied once more. Now this came from our capturing the crash scan. Oops, there we go. Okay, here this came from our capturing the crash scan. So let's look at the chart first. And let's zoom out a little bit. Okay, so based on, I'm going to go a long way out, but based on the macro picture, we could see where the key Fibonacci levels were. And remember, we're looking at this in the context of a major market meltdown, so we're measuring Fibonacci's back from the 2009 lows, because things could get that low again, or at least 50% of the way there. So what we saw is that the stock had broken its key Fibonacci level. It was heavily underneath the moving averages. It came up in our capturing the crash scan. And again, what's the smart money telling you? As the stock went basically sideways, the smart money dove. And so this is one that we alerted for puts, which was a 257%, almost exactly return as well. So these are the kinds of things we're looking for. What else? When the market dove, ALNY, another example. This is one that we picked as a short, actually back here. Again, you can see the upward channel, stock rising, but smart money going lower, and in fact crossing negative as it broke down out of that channel. So this is one, I actually just sold my puts on this yesterday. We bought them for about $3.80. We sold them for $18.90. NUGT, probably my best trade this year. And I'm done with this now. Gold, I think, has exhausted itself. It's a bit scary to chase. But there you go. Now, does anyone know what pattern this is, by the way? And I'm going to start taking questions for the stocks that you want to look at in a second here. Does anyone know what this pattern is called? It's one of the highest probability patterns that exist in the market. Yep, Ridiculo, you've got it right. Yep, it's a saucer, or otherwise known as a fallen angel, or a bump and run, or a frying pan. There's different names for it. It can sometimes be a cup and handle, but essentially whenever you get a period of oscillation combined with a little scoop at the bottom, it looks like a bit like a spoon. It's one of the highest probability patterns you will ever find in the stock market. And And this tells us that momentum is in the system and it's ready for a run. So when this was at $25, we alerted to our students that we were going to be buying $45 March calls. And I think we turned about $3,000 into 15,000 in just a few days. This was an easy trade to do, and it was easy to assume that much risk on such a volatile stock because of the pattern being so probable. Now, we're going to come back to questions here in a moment. What did LinkedIn look like before the fall? Let me show you actually one that we didn't pick LinkedIn, unfortunately, but let me show you, and we will go to LinkedIn, but let me show you one we did that had just as impressive of a drop. Lionsgate Entertainment. This stock was, again, one of the stocks that actually came up in our Capturing the Crash scan. Oops, where are we going here? Apparently I click as well as I speak. All right. What do we have here? So again, let's analyze the pattern. It's all about patterns. So the most important thing you ever have to learn is to make sure you draw trend lines correctly. Because once you know how to draw them correctly, it's not subjective. Some could tell you that it is. It's not. Trend line drawing is not subjective. You have to know how to do it correctly. It's always left to right. And once you know where the trend lines are, then you know what the pattern is. Once you know what the pattern is, there is no guesswork about how to trade it. Every pattern has very specific rules on when to get in, when to get out, and how much profit to expect, what a stop loss you should use. So we see an upward channel. That tells us bearish. We see that as the stock rallied, the money flow, the smart money, was selling off in droves. And then as it broke down, what was the smart money doing? Does anyone see what I'm talking about? This was a no-brainer. This was easy as pie. It came up on the scan that day. We looked at it. We say, right, bearish pattern. Right, money flow is getting the hell out. We checked the insider selling. Everyone was selling it. Everyone. And so we said, right, let's pick up some June $30 puts. And a few months later, it gapped down 30%. These are you don't find one every day, but when you find something like this, you buy it. You buy the puts. We'll go to LinkedIn. Have a look at LinkedIn. What do you see the smart money doing? Right? Compared to when it was the same price. This is what we call divergence. Same price, significantly different smart money. Okay, now we're going to come back to specific stocks in a second, but I want to be respectful of everyone's time. For those of you who have to leave and enjoy your weekend. But that's the thing, is that you need to know what you're looking for. And I'll stay around and answer questions as long as Jeanette will allow me to. But you need to know what you're looking for. If you were to go out and buy a car today, and you say, right, I've got 2 kids, so I need a four-door car with a boot, or I'm not sure what you call it in North America. The thing in the back you put your stuff in, a trunk. We call it a boot in Australia. Anyway, with a ski rack on the roof, and hey, I'm going to, and my budget for that car is going to be 20 grand. Okay, now if you come back with a 2-door sports car, convertible, that you spend 80 grand on, you're probably not going to have that family much longer, right? So why do we go out and why do we go out and have very specific things, very specific criteria that we buy everything else with? No, I will not budge on that price. That Big Mac should only be $1.50, sir. You know, why do we stick to our guns on everything else? But then when it comes to trading, we're just wandering through with blindfolds on, saying, hey, you got a good idea? Yeah, I'll put some money in. Oh, I lost some money. Damn the market. You know, we need for. So what are we shopping for? If you took a pen and drew exactly what you wanted to buy tomorrow, what the chart would look like, what would the volume look like, what indicators would you look for confirmation from, and what values would they have? Don't just say a MACD that's positive. How long is it in positive for? Is it divergent? Is the RSI below 30 or above 50? How much has the volume gone up by? These are all factors that create the recipe of how algorithms work. So if you don't know exactly what you're looking for, then how will you ever have consistency in your trades? So this is a question that I beg to ask, is do you know exactly what you're looking for? And, you know, most people don't. Most people say, yeah, the stock market's probably going to crash, but gee, I don't know what to do with that. How do I make money from that? What stocks are going to fall the most? And that's kind of where we start to get into really understanding what I've kind of referenced a few times, which is the patterns, and understanding how these systems work in relation to the smart money. And I'm just going to quickly move on to the slide here. But yeah, once you know exactly what you're looking for, then you can start scanning for it. Technology can do amazing things these days. The reason why algorithms are making billions and billions and billions of dollars, and why the 1% of the world has 99% of the wealth, is because they're systematic. There's no one behind these computers making decisions. They're rule-based. But everyone's so caught up on being right that they are constantly second-guessing themselves and never develop rules. So ask yourself, in your trading, are you being efficient? And if you look at the 4-hour work week, the definition of being wealthy or efficient, he says, is compare the guy that makes 100 grand a year working 60 hours a week, or the person that makes 60 grand a year working 10 hours a week. Right? So now take it to trading. How many traders spend all day long staring at the screen, watching something they're already in? Why are you watching it? If you have a strategy, if you understand the patterns, the rules will tell you where to get in, where to get out. I day trade. I day trade options. I day trade options that expire the next day on the SPY. I'll have 20 grand in an option that could be worthless in 5 hours from now. And I don't sit at the computer and watch it at all. Why? Because I know where I'm getting in, where the support is, where the trade has been wrong at. In other words, at exactly what price I want to get out, and if it goes up, where I will exit. I know where those levels are, and that can all be programmed in. So if you know what you're trading, and if you know what patterns work, what the higher probability patterns are, and how to apply them, you should never have to sit there and watch the grass grow. And that's what strategy is about. That's why high-frequency trading is so profitable. And that's also how you get consistency. It's not just about making life easier. It's not just about having rules that you can follow so you don't have to go to sleep stressing about whether you made the right choice or not. Or as Guido says, babysitting your trades and wasting your time doing it. Wouldn't you like to just have 10 trades where you said, okay, I'm going to buy all of these at $10. If any of them go down to $9.90, I'm out. And if they go up to $10.90, I'm out as well. So I've got 9% profit for a 1% risk. I'll do 10 trades like that, set them all up, and walk away off to the pool. That's what you can do. And as long as 2 of them work out, you've made money. And then you never have to worry, because you know as long as you write 30